and welcome to Your Money. I'm Vivek Law. Today is a very special show with the focus on ULIPs. As all of you know, a few days ago, the IRDA, which is the insurance regulator, came out with a string of measures as far as ULIP products are concerned. Now, there have been concerns about mis-selling in ULIPs. There have been concerns about the regulatory jurisdiction, which has now got sorted out, thankfully. But let's try and understand what these new norms mean for investors, for those who want to buy a ULIP. So joining me today to discuss this is Puneet Nanda, Executive Vice President at ICICI Prudential Life Insurance, Vikram Kotak, who's the Chief Investment Officer at Birla Sun Life Insurance, and Sanjiv Bajaj, the Joint Managing Director at Bajaj Capital, which is one of the leading distributors. Puneet, let me come to you first. Perhaps one of the most important things that these guidelines do is to extend the lock-in from 3 to 5 years. Now, while everyone at the top level of insurance companies, including you, have forever, ever since the beginning, been saying very emphatically that ULIPs are long-term products, they have unfortunately on the ground been occasionally, or perhaps more than occasionally, sold as short-term products. So do you welcome this shift away from 3 to 5 years?
No, definitely. As we've been saying all along, and as you pointed out, ULIPs are supposed to be long-term products, and though there may have been some cases where it gets sold on a short-term platform, but frankly even then it was perhaps sold as a 3-year. So any move to increase the tenor of the product, to make it more long-term, to make it more protection-oriented, to make it more transparent, is obviously a very welcome step, because ultimately if the consumer benefits, the consumer stays with us, which of course is great for the industry.
The other major thing is that withdrawals are going to be not allowed anymore, Vikram, from pension products. How do you see this?
I think that also again makes that what I see ground level. Perhaps sometime it happens that people try to kind of use this opportunity to move from one product to another product, and a lot of churning happens around. So I think it's one of the way to kind of handle that. On the other side, if you look at one of the important feature which IRDA brought is the loans on the ULIP, which is making sure that if the policyholder needs money in the urgency, there is the opportunity to take a loan on that ULIP product. So that's very, very positive.
Puneet, let me come back to you. There is this 4.5% guarantee that, you will now need to give. Now, there is a bit of a criticism about this, because at the end of the day, when you look at a pension product or a long-term product going over 30 years, you expect a fair amount of money to be in equities, because that's what really grows over a period of time. If you have to deliver a guarantee, albeit of 4.5%, does it not restrict you from being able to give the investor a higher weightage towards equity?
You've hit the nail on the head, Vivek. That's absolutely true. Frankly, what this 4.5% guarantee does is that at the, it does protect the downside for the consumer, so it does give the consumer some peace of mind, protect from the vagaries of the market. But frankly, for a long-term product like a pension product, this is not going to help the consumer to even beat inflation. To generate, returns which are commensurate with what's happening in the economy, to generate returns which are going to beat inflation. More importantly, end of the day, it is a pension product to generate returns which can help an individual to sustain the individual's post-retirement life. It is very important to get returns which are significantly higher. That can only be done by taking some risk in the form of exposure to other asset classes like equity. So this norm will definitely restrict the kind of exposure that can be taken to equity.
And if I may add, Puneet, the NPS, which is the other pension scheme of the government, that doesn't seem to have any such distinction. There I can still go and take a pure equity option, isn't it?
No, in NPS there are 3 options. It ranges from 0 equity to maximum 50% equity. Since we are one of the fund managers there as well, it does allow in one of the options up to 50% equity.
So what you're saying is you don't fear that there is going to be a product arbitrage there?
No, it's not the question of arbitrage. I think both are options for the consumer. It is up to the consumer to choose what the consumer likes, but I would definitely want to make the point that a 4.5% minimum guaranteed return on a regular premium product in a country where there aren't enough long-term hedging tools available is going to be a challenge.
All right, Sanjiv, let me come across to you. There's a lot here as far as charges are concerned. Now, one of the very big criticisms, and perhaps to a large extent a fair criticism of ULIPs, has been in the past about the fact that the commissions are high and more importantly, they're front-loaded in the first year. Now, an attempt has been made in these guidelines which says that it will have to be evenly distributed in your first 5 years, and then subsequently there has been a cap which has been put for the duration of the term. How are you reading this as a distributor?
See, I think this particular benefit as such is actually not a benefit, because it really doesn't make a difference. You have already taken care of the customer by defining the maximum yield loss. Now, in saying the same charge has to be charged over 5 years, there are a lot of policies which are charging a small amount or a decent amount in the first year, but there were very low charges in the second, third, fourth, fifth year. Now, to meet the distribution cost, what will happen is that insurance company will have to take that charge over 5 years, a higher charge. So see, they will have to pay the distributor, and if the distributor wants an X amount of money to sell in the first year, then the same charge will have to be levied in the second, third, fourth and fifth year. So the customer will end up paying higher charges for no rhyme or reason, and that charges will neither go to the distributor, it will be retained by the insurance company. So for the insurers it may be slightly better, or they may have to upfront that to the distributor. But to a certain level, I don't think that really benefits the investor. And what it is also doing is that when we are all talking about making ULIPs a long-term product, and most of the other changes are towards this long-term nature of this product, when you restrict the charge and when you say that, okay, if the policy is surrendered after first year, maximum yield loss can be 4% even if you have bought a 20-year policy, this is actually going to cause a lot of people to sell these policies as a 5-year plan. So this is actually not right. So I feel that yield loss takes care of the customer's interest, where you have defined above 10 years it is 2.25, less than 10 years is 3%. I think that was good enough, and this really doesn't help benefit the customer. It will actually end up causing a little bit more of mis-selling.
But it's better to sell it as a 5-year product than a 3-year product, right, Sanjiv, which is what was the case till now?
Yes, but there were also people selling it as a 20-year product, so you can't say everybody was pitching it as a 3-year product. Yes, but 5 years is definitely better than 3 years, and that is better for the customer because he lets the money grow for a longer time. It is better for the fund manager and the insurer that he has the money for a longer time. So that is win-win for all. But when you talk about making the charges very low in 5 years, then that would also mean that it will be positioned as a 5-year product by a lot of people, which really doesn't help the investor.
Well, in the Indian context, I think even 5 years is a lot of time, considering that our definition of long-term perhaps is, 5 months in most cases. But let's take a short break. We'll come back and take some queries of our viewers for the 3 gentlemen here that we have today after the short break. Welcome back to the Your Money ULIP special. Vikram, if I may come to you, as far as the sum assured is concerned, it's now 10 times of your annual premium as against 5 times earlier if you're under 45, which means you need to take more cover. Now, again, people like you have been arguing that a ULIP is a combination. So, and the first important part for any investor really is, consumer really is, to make sure that your cover is adequate. And most of us are inadequately covered. So do you think that's a good move?
That's very good move actually, because finally you want to, as I said earlier, that you want to finally make the purpose served, that this is the combination of the protection and the wealth. So you need to see that you are adequately covered at a particular cost. And balanced money, if you think that you want to kind of create a combination, and the country like India where the broad prosperity is going to go up, or the growth in the country is going to grow up, it's a good opportunity at a very reasonable cost. So I think I'll happy with this move that cover has gone up to 10 times.
Puneet, what is your opinion, just drawing you into the same point that Sanjiv was talking about, as far as the charge structure is concerned, how are you viewing that development?
The charge structure, I think there are 2 big initiatives. One is to spread out the charge during the lock-in period, which is
welcome that?
5 years. I think it is both good and bad. It's good in a way that it may improve persistency maybe beyond 3 years, but the issue is that it can restrict product structuring, product innovation. The other problem honestly is that irrespective of commission, most of the expenses in manufacturing a product are indeed front loaded. Honestly, Indian accounting guidelines do not allow amortization of these expenses. Now if what I can charge are effectively being amortized over 5 years, then in reality in the first year the capital requirement for insurance companies will go up significantly, and for companies which are relatively young or which do not have enough scale, it could push back their break-evens very significantly.
But from an investor's point of view, Puneet?
From an investor's point of view, I think it is, I would definitely look at it as a good step, except that it reduces flexibility because the options in being able to create a product get reduced. So basically there will be one single kind of product. Yeah, it's good because it will have some standardization. It will also help in customers having a very clear view about what things will look over, say, a 5-year term.
All right, we've got Amit on the line who's from Mumbai. Hi, Amit.
Yeah, hi.
Go ahead, what's your question?
Yeah, is it the right time to start investing in ULIPs?
Okay, but before I toss this question, let me ask you, why are you looking at investing in a ULIP?
Well, I'm 58 at the moment.
Okay.
So, do you think it is the right time for me? Because at this age, would you advise me to start investing in ULIPs?
Okay.
Would it give me adequate cover together with the growth that I'm looking for?
And I would understand you're looking at what, a pension-related kind of a product?
Yeah.
Okay. All right, Sanjiv, even though if I may say so, and maybe you agree or disagree, maybe it's a bit late in the day for him to get into it, but having said that, would there be sense for him? He's 58, so, presuming that he can have a good clean run of at least 15 years, if not more, with the product, would you still advise him?
So as you have actually said that, probably 58 is slightly late to start a ULIP because you are looking at a minimum 5-year locking now. So that means you cannot touch your money before you are 63. So it all depends on what you feel you're going to be earning till. If you feel that I'm going to be earning money till 65, 70, you have to understand ULIPs are products where you invest regularly and they give you a life cover, and that life cover goes towards protecting your family during the wealth creation stage. So that something happens, that money is available to them. So yes, if you are going to be earning till 65, then yes, ULIP is a very good product, and you can actually pick up some good instruments now with the charges being capped, which were previously done in January. You will have some very good options available for 7 to 10 year horizon. So, but you have to be very clear. Pick up a product which is structured to deliver you results in 7 to 10 years. Don't go for a 20-year product at this age. There you will not get the desired results. So if you look at a 7 to 10 year product and you're assured that you'll be earning for the next 7 to 10 years, then it's a good time to get into ULIPs for your retirement and family retirement needs.
All right, let me come back with a question to both Puneet and Vikram. What I've heard both of you saying is that by and large, except for an odd disagreement here and there, by and large these guidelines seem to be very much in favor of a customer. Now therefore, if I'm a customer wanting to buy a ULIP, should I wait till September 1st when the new revised products come? Puneet first.
No, honestly, if you do your research and pick a product well, any time is a good time really, especially if you think of it as a long-term product. Any time is a good time. Having said that, the new guidelines have definitely improved the customer proposition significantly, but that's more by way of having more flexibility, by reducing the charges a little bit, by increasing the cover. So it all depends on that, on what your need is. Yeah, if you're focused on some of these micro issues, then you may want to wait till September 1. But frankly, for a long-term product like a ULIP, it doesn't really matter that much, assuming that your goals are clear and that you are sure what you want.
Vikram, would you agree with Puneet?
I think partly with Puneet, but I think if you are buying anywhere for 20 years, it makes sense to wait for 3 more months.
All right, okay, we take a short break here. We come back with some more questions for our viewers. Welcome back to Your Money ULIP special. Puneet, one of the things that seems to have, not really been talked about ever since these guidelines came is this, that while recently we had, the second draft code of the DTC which came in. Now, if I look at these guidelines, there seems to be now a very little case, if at all none, to not give the EEE benefit to a ULIP, because if you see the second draft, it talks about making sure that a product has enough safeguards so that not to encourage premature withdrawals, encourage long-term investing. It also talks, the first draft had talked about a pure life insurance product as being one where there is at least a 20-time, sum assured to the premium. It's already gone to 10 times. So do you think now, as far as the tax treatment is concerned, there is no reason why the bill which will be introduced should not give that tax benefit to a ULIP as well?
I fully agree with you, Vivek. That's exactly the way to look at it. With these new changes in the ULIP product guidelines, with the minimum term having gone up, with the protection level having gone up, with the kind of risk cover that is going to be there in all kinds of products, clearly these products can definitely be called as pure insurance products by all means. And the fact is, it's not as if the insurance industry or companies have taken these calls. The regulator, having consulted various entities, has taken this call. So after all this, I would definitely say there's a clear case to include these products on the EEE platform.
All right. Vikram, from the point of view of returns, because that's the other thing which consumers, investors always look at, and again we are talking long term, in this new structure which has been created and gets kicked off from September 1st, since you are the one who really manages the money, do you think you have more flexibility, not talking about the pension plan side, because that Puneet already articulated that that's not a very positive thing that has come out, but on the other side, do you feel far more relaxed now as a fund manager, from a fund manager, never mind the distributor or the company's bottom line, but as a fund manager who's going to give returns?
I think one big thing is the more allocation in the hand of customer in the initial year, which will definitely bring more money to the asset manager, which is a good thing. Second, I think what I'll see a lot of discipline, not only coming in terms of the distributors and manufacturers, also in the terms of the customers, because customer will start looking this product at a very different way, because the cost structure with rationalized and the value proposition are actually going up. And I think customer will try to see that this is getting more long term, and it doesn't help you if you keep surrender and flip to other products. I think I also see from both angles, both customer and the investor angle. I think this is this is going to really help customer at the end of the policy term or the maturity period.
All right, let's go across to Delhi. Richie Gupta has a question. Hi, Richie.
Yeah, hi. This is Richie Gupta. Actually, I have this LIC Profit Plus ULIP policy 188. I'm paying a premium for 35,000 half yearly. Every year I'm paying it on time. January and June are the dates when I have to make a payment for 35,000. So I've paid till now, it's been 3 years. I need to know what kind of return I'll be getting, or should I expect, or should I continue it because the blocking period was for around 3 years. I have to keep on paying my premiums till 3 years.
How old are you, Richie?
Continue paying. I'm 24 years.
24. Okay. Well, first up, many congratulations that you started at 21, and I think that's a damn good thing. Secondly, I think if you've heard what we've been discussing, 3 years is not the time frame for which you buy a ULIP. So certainly that question is out. I don't think you should start thinking just because 3 years is over you need to stop contributing. I think that needs to continue. But I'm going to throw this open to Sanjiv. Sanjiv, would you like to guide him? 3 years is again a very short time to judge a scheme, but so far, is it all right, this scheme that he's been in?
Yeah, you have chosen a good scheme, and it's a low-cost scheme, but it's an upfront charge scheme. So you have already paid the charges in the first 3 years. So now if you keep investing in this scheme, it's a very low-charge scheme. So my recommendation to you is that if you are able to, if you don't have the requirement of liquidity, try to carry on the scheme for as long as possible, because you're giving your money a chance to grow. And also on the return side, so you have to, this is a ULIP plan, your returns are not guaranteed. It depends on the fund that you have chosen. So if you have chosen an equity fund and you have a 10 to 15 year type of a horizon, then I feel you should be happy if you are able to get between 10 to 15% type of a return, which I feel is possible given the way the Indian economy is growing and the kind of growth expectation we can have. But that's again a long term. Equity does carry risk. If you want to have a lower risk, you can probably choose debt. You can probably choose debt, which should give you a return in the range of 6 to 8% given the current rates. And if you are moderate, then you can probably choose a balanced fund, which should aim at giving you a return between 8 to 10% over the next 10-15 years. But my thing is that please continue the plan. You have already paid the charges. Now it's a time to, enjoy the low costs that a ULIP plan offers if you invest for the long run. So there is no question of surrendering down unless you have the need for liquidity. And that's what I would say.
One final question, Puneet, just to get this clear as far as other investors are concerned. Now, yes, while all new products from September 1st will come with these new guidelines, what about the premiums that I contribute? Agreed that the premiums I've already contributed will be, fine, but the fresh ones, would they also then now come under the September 1st new rules?
No, I think it's very clear from the guidelines that only for new policies sold with effect from September 1, these rules are going to be applicable.
All right, many thanks, gentlemen, for coming over and clarifying all these doubts. So, well, as you've heard, the majority view is these are guidelines that are in your favor, but the bottom line is that you need to be invested in a ULIP for a long term. That's really the message coming out, but a lot more coming your way from the regulatory mechanism in terms of making the ULIP a better product for you. That's a wrap on this ULIP special of Your Money.